It's 7:02. Let's wait for 3 more minutes and then we start. Yeah, that is fine. It's a big topic, important topic. We can start now. So usually we start at 7:05, but given that the topic is very hot, we have a lot to cover tonight. So 7:05, but given that the topic is very hot and we have a lot to cover tonight, so it will be good to start now. We have got a good number of participants who have joined. So guys, welcome to the webinar today. And this is the most hot topic for property investors in Australia at the moment. And it has raised a lot of questions and a lot of ambiguities at the moment in the market. People are confused, are holding on to their purchases because they're not clear. Should I buy under my personal name? Should I buy under my investment trust? So I hope that this webinar today will help to clear a lot of things and give you guys direction on this one, where to head, how bad are the things, right? Is it really bad? And is the property investment still for me or not? So without delaying further, we'll go into the webinar. But before that, I'd like to introduce myself. My name is Pratiksha. I am the co-founder of AP Buyers Agency. And me with two other people will be your host tonight. So first, my business partner and co-founder, Anita. She is the strategic property advisor, and she has spent last 2 weeks since the budget is released to go through each and every paper in that and get out all the details. And what we have done, because excuse us if we by mistake give any incorrect information, because we also received the information 2 weeks ago, and we're kind of trying to decode everything. And just for the authenticity purpose, we have used the same document which is released in the budget document. So all the examples, all the numbers are same. I think what will help is giving a call to your accountant and having a detailed conversation about this. And apart from Anita, I have, so Danush couldn't join today, but we have Benita from Australian Lending Agency, and she specializes in SMSF lending and commercial finance. So both of which you will hear today, and that will become, you'll see that after this session, that will become very interesting after the budget. So a quick housekeeping, this recording. So this will be recorded. It will be posted on our social media tomorrow, as I think lots of people are waiting for this. So you will get to replay. We will send you the slide deck as well tomorrow morning. So we'll do content. We'll try to cover. We have a lot of things to cover in 50 minutes, and then we'll open for live question. But in the meantime, if you like remember any question, get any question, just keep posting in your chat box, and we'll pick it up at the end. So here's I'll move to the next slide. So here's where we're heading tonight in 3 lines, that major property tax changes, they kick in next 2 years. So it's a lot of things to cover, and when everything kicks in, like some of the changes are valid immediately, some of the changes have a 13 months window, and some of the changes till 2028 as well. So what I'll do is I'll pass on to Anita. She has done a detailed research about that. So over to you, Anita. Thanks, Pratiksha, and good to be here with you all guys today evening. And before we go deep dive, I just want to put a disclaimer. We are not giving any financial advice over here. We are just representing what came out from the budget. So for any financial advice, talk to your accountant, a broker, or the financial advice. So if you look at the screen now, so it has the number 13. Just have a look at that. And that is how much months we have between today and 1st of July 2027, the date the federal government has chosen to switch on the biggest set of property tax reform since 50% GST discount was introduced in 1999. So I don't say that lightly, guys. I have been pulling this budget apart since the moment it was handed down on 12th of May, and I can tell you this is not a minor adjustment. It is a structural rewrite of how negatively geared property works, and how the capital gain works, and how the family trust that own property works. So three reforms. They affect every property investor in this country differently. Some of you in this room tonight are going to be winners, and we will show you exactly why. And some of you are going to be more exposed than you actually realize. And every single one of you has a decision to make in the next 12 months that will define your portfolio for the decade ahead. So tonight is not about panic, it's about clarity. By the end of this hour, you will exactly know which reform actually affects you, what your strategic options are, and where the smart money is moving now. So let's start what actually changed. So let's go to next slide. So many reforms, many changes which was announced on 12th of May. But for a property investor, there are three major ones, and we will be just focusing on that. So we'll be just committing to these ones uh, today. So let's see the reform number one, which is on the negative gearing. So from 1st of July 2027, negative gearing is restricted only to the brand new builds. So if you have ever bought established investment property and use the rental losses to reduce your tax bill, that strategy is now changing. New build keep the benefit, existing stock does not. So we will, in the next few slides, we will go through much details on this. We will show you the examples also. We will do the comparison as well. So stay tuned for that. The reform number two is on the capital gain tax. So from 1st of July, the 50% GST discount that we have had for 25 years is being replaced by CPI cost-based indexation plus a 30% minimum tax on the gains. So instead of just halving your gain, your index, your cost-based inflation, and you pay the tax on the difference. And again, we will go through this in detail with examples. Now, number three is the discretionary trust. So from the 1st of July 2028, so a year later after these first two reforms, the trust pays flat 30% minimum tax. So the classic split, the income to the spouse and the kid strategy essentially neutralized now. Good examples is the tax. Right now, let's go deeper into reform number one, which is the negative gearing. Let's go to the reform number one. Yeah. So this is the in one sentence. Okay. If your renter loses money in any given year, so interest plus expenses minus rent is equal to loss, which you can directly use to reduce your tax from your salary. That is the negative gearing as of now how it is. The new rule which says from 1st of July 2027, if you bought your investment property after 12th of May 2026, that rental loss can only be deducted against other property income or capital gains, not your salary. So excess losses is carried forward to future years. So again here, when earlier it was announced and I was talking to buyers, who had lots of questions. So are we losing it? So we are not losing it. It is now I want you to draw your eye to the right of the screen because this is where opportunity lives. So five categories of the properties and the investments that are not affected by this change. New builds. So brand new builds retain the full negative gearing and this is deliberate. The government wants more housing supply. So they are keeping the incentive for anyone funding new construction. Now, number two is the SMSF. So SMSF is completely excluded. You hold the property in your super and nothing changes for you. Number three, there are so many other type of trusts like the widely the health trust, the most managed investment trust is excluded from there. And this is the huge. Any property which is held before 7:30 p.m. on 12th of May 2026 are grandfathered forever. If you already own it, the old rule applies for the life of that investment. Number fifth is the commercial property. The reform targeted residential, commercial is unaffected. And the Treasury is estimating around 230k Australian negative VA properties every single year. So it is directly impacting those people who are buying existing property from like after the budget announcement. So go to the next slide. Now let's look at the three. So memorize this because every conversation we have with clients right now, it starts starts from here. So the first category is the grandfather. If you have a property before the budget day, that exact moment the treasurer stood up to deliver the budget, full life forever. There is no expiry. So if you have exchange contract that hadn't settled yet at 7:30 that night, it still counts as head. Hold on to that property. That grandfathering is genuinely valuable. Number two is the transition window from 12th of May, 30th of June 2027. That is, if you buy anything in this window, you can negatively get it normally, but it will be just for a year. So I don't know how much important it will be, but at least it's good to know. Now, category 3 is restricted. From 4th of July 2027 onwards, no negative gearing against the salary on the existing stock unless, and this is big unless you buy qualified new build. And in which case, if you buy a new build property, then the full negative gearing applies. So your strategic question right now in May 2026 is this: where do you want to be in this picture in 12 months time? Because 13-month window is the only window you will ever have to acquire established stock with a full benefit attached. After June next year, the door closes. So like we had few buyers who came there saying that, okay, do we just buy new properties now? So what we are going to do now, we are going to give comparison buying new versus buying the existing properties, and we will show these numbers are directly from the report which came out on the day, just to ensure the integrity of that. So look the real numbers, because that policy helps. Because just without examples, it won't be much. So typical A&P client profile, which we have, 90% of the clients, around 120K, they are buying 650K investment property, with 90%. Scenario A, they buy existing property, standard established home, their annual rent is $29,250, say for example, their interest bill on that loan is 38,000, other cost rates, insurance, management, maintenance, other $7,500. That puts them $16,275 in the red on the rental basis. Under the old rules pre-budget, that 16,000 loss reduce their taxable income, gives them the tax refund of about 6,500 depending upon the income. Under the new rules, there is no refund back. The losses are not gone, but it has carried forward. So they will get the benefit eventually, but not right now. So all money, though negative geared amount is coming from the pocket as of now. It will be same invested, same number. So let's say in the same amount, in 650, they have bought some new property which is a bit far off, and say same loss, but if it is a brand new identical 650 price tag, the rental loss is still 16 and a quarter thousand, but now negative gearing is working against their salary. They get 6,500 back, so their out of pocket holding cost drops to under $10,000. And remember, I haven't spoken about depreciation yet. New builds typically attract $8,000 to $12,000 of depreciation in a year, most of which is non-cash deductions. So the new build investor is generally $6,500 better off 1 year before the depreciation. So this, like if you see number wise, this looks much better. Now, and this gap is a meaningful gap. Complete over the year, and you will see that the fundamentally the picture is very, very, very different. So let's go right now where you compare existing versus the new build and see the outcome. So the same investor, same property, but look at 10 years out. This is where the difference compounds. Left side, existing property over 10 years, they have accumulated around say 120K, carrying forward rental losses. That sounds like a tax sheet, but remember those losses can only offset rental income or the capital gain. They cannot offset the salary. So you are sitting on a delayed tax benefit. Okay, so it's not that the benefit is gone, it is delayed. Now let's assume 4% of capital growth. Property sales for say, I'm just putting the rough numbers, 962K, nominal gain of 312K. Under the new GST taxation rule, the estimated tax bill on that gain is roughly around $44,000. On the right side, a new build negative gearing fully retained on the entire holding period, salary tax saving over the 10 years, somewhere in the order of 60,000 to 80,000, depending on where your marginal, the rates are. Take that the depreciation, they are the real number. And critically, at the sales, the new build investor gets a choice. They can use 50% GST discount that still applies to the brand new builds, or they can use the new indexation method, whichever gives them lower tax benefit. So that option alone is worth thousands. Bottom of the screen, for investors using the leverage to buy the property and relying on the tax offset to make the numbers work, new build materially outperform the existing stock on the 10-year hold from 2027 onwards. That is the takeaway. Now, here I'm not saying that new builds are always better. There are real downsides, and let me show you both the sides of this investment honestly. So let's see the pros and cons of the new build versus the old build. So see, the new build, for buying a new build, always the premium price has to be paid, maybe 10 to 20% more than uh, the old the existing build. Plus, remember, the most of the time the existing build on the bigger lot size, and it is near the city or the CBD, whereas new build is always the time it is far off from the city on the okay. And how I see is over the time, even the new house will become the old hand, so old house. So at the end, property for land will matter. So the existing property with more land, like definitely it is bit painful that, because the negative gearing, uh like if you're using the negative gearing, you can now it has the amount has to go again. If you have a property which is neutrally geared, or if you have a property which is positively geared, then this does not matter at all. So now let's see I think even the next slide I've gone through that, for the new builds, what are the pros and cons? We are paying the premium price on that. The land would be the smaller, it would be the far from the main like established area. There would be a risk oversupply. Like for the new builds, there would be a risk, the builder has signed a contract, but the build takes time. And there could be so many issues with the new build. With the new build, like the cracks and the settlement crack, they can happen in the initially. So these things have to be taken checked, taken into mind. So A&P side, we do not say that new build is better or the old build is better. Bottom line is both pathways work for the right investor, but they work differently, and the decision needs to be made deliberately and no default. So like that only new build is good, or only the same. So we look at the portfolio of individual buyer, and then we say, okay, for this particular buyer, for this particular portfolio, let is the right way to go. And let's see a real example which Treasury has given, and this is the interesting one. Okay, so they have given example of a person. So I want to show you how worked example that comes directly from the Treasury, not from us. It's the Yunsu from page 7 of the budget paper on the negative gearing rate. She buys existing residential property for 519. That includes, crucially, she buys after the policy starts. So the new property is negative geared. Her net losses equivalent to 22,879 of the carry forward losses. So she can't touch those against her salary, but they are banked. They are not lost. Now, year 6 to 10, the rent has gone up now. The property is cash flow positive, and she applies those bank losses against the positive rental income. So her tax bill on the rent is now reduced to zero. Say year 10, if she wants to sell the property, say for example 814 K approximately, there is a still small remaining loss balance of the yearly, and that applies against the capital gain. If you see on the number side, overall full 10 years, you will to pay $186 more in total tax than she would have done under the old rules. So it's $186 over a decade for 500K property. So that message Treasury wants you to take from this budget. For long-term holders, the difference is small. The headlines have been dramatic actually. And the actual numbers for the buy and hold investor are surprisingly contained. And now, here is the kicker. If Yinsu had bought a new build instead with the same numbers, she would have paid zero additional tax. The new build investor wins, but the existing property investor isn't that much worse off. So let's go to the second reform, which is on the capital gain tax. Projector will walk you through that. So, looking at like the like whatever Anita said, it's like the hearing which is being talked about and people are scared about that, not that bad. So it's going to work like if someone the property in investment it will work in the yes you will not get tax benefits upfront, but actually added at the end. So it impacts your holding capacity, but at the end doesn't make much difference. Now, the capital gains tax, I think that's where the major change is coming. And so let's go into this and see the 50% CGT that was introduced in 1999, right, in John Howard's government. So that is about like a generation has seen this type of CGT. Now that we completely abolished, and that is abolished for all the individuals and partnerships. So that will be gone, but the CPI indexation is introduced. Now, so what is going to happen is instead of directly halving your gain, right, and giving a 50% discount, what ATU has introduced is um, every year, whatever um, inflation is there, year like approximately two of that from the of that, and based on that, the capital gains tax will be calculated. So, based on the analysis, our analysis, it looks like it's not a straightforward calculation like it used to be, and it needs certain criterias before we end up the end how much CGT we have to pay. So that this applies to all CGT more than 12 months. So that includes property and also includes the shares, business sales, for like basically any capital asset you hold for long term. That's one of the thing. The other thing is, yeah. So I think will be important is see how the indexation will work, and see in real example how that 30% will impact like what tax you pay at the end when you sell property. So for the main residents, that's the main resident CGT exempt, so that's good. For affordable housing, there used to be 60% CGT, that's retained, so that's not touched. So that's actually good. I'll go on to the slide. So this is a perfect example of um, how this is a comparison given on the TU's website comparing old method versus the new. And if you look at it with the old method, right, the CPI discount for holding a property for years, that was a 42%. Um, and the effective tax rate at 47% is so it means is over the past 20 years, the effective CPI discount on the house held for 5 years, that would have been 42%, and house held for um, 10 years is 36%. Now, what um, we would end you is, call your and explain your scenario. Like have a property under your name versus trust. Um, what sort of estimated CGT based on 2.5% inflation we can expect and add a 8% growth of the property each year. So at the end, how much is the CGT you'll have to pay? And then you can compare it with the old method. That should give you a um, that should give you on like what CGT you can expect. Now, type of calculation depends on a couple of things. One is the like CPI discount, the CPI inflation rate is available online. Other than that,
Like, let me show you how it will have like three investors on the screen right now. And I'll say, for example, I've bought a 500,000, um, 500K property sometime like in bought in when it this effective, right? And say they hold this for 10 years. Same income earnings like 100,000 and same inflation of 2.5%. So the person, Ben, that person buys in area where um, it's a low growth, maybe some sort of unit which doesn't grow at a rate. So under the new rule, Ben will pay 24,000, approximately 24,000 less tax compared to old methods. He is the winner. So basically, it looks like whatever um, growth you get on your property, the CGT will proportionate based on that. So, say for the second where David um, earns 5% per annum. That's the typical Australian property average, including all the regional areas. So for that, David pays approximately 8,000 more tax. So that's a modest, modest hit, not like not nothing catastrophic. So, but okay, so someone who has, for example, in 2021, they bought in Brisbane, they bought in Perth in 2024, and they're getting a very good gains every so Kate would end up paying more tax, and that be approximately at 7.5% return per annum, which all of us know that for suburbs in Brisbane and Perth has given like 15, 20 to 25%. So the tax will determine based on growth. So I hope it's a little bit clear, but definitely a full will be when you have your own scenario written down with your accountant and do the numbers on that. And there are one things which we're still figuring out how the ATO is going to value the property each year and then determine how much growth it had. So probably we might get those details later on. So moving on to the next slide. So this is another example trying to show how much investor would pay. So this is a given on the website. Now, this is not a big difference. It's not making much difference, and it shows that if someone buys a property um, and before 12th of May and then sells it 2 years time, what will uh, be the CGT? That the CGT will be applied marginally, like before the budget, 50% CGT discount will apply, and the budget till the person till the time the new budget will apply. So this even complicates the taxation, like the way the CGT will be calculated. Yeah. So next slide. So I'll hand over to you, Anita.
Yep. No, thanks, Mr. Diksha. So we have covered reform, which is negative gearing. Reform two is most of the buyers which called me ask about this. They were little bit up and down, and they knew things about that. Now this one is really interesting. The third reform on which is on the discretionary trust minimum time from the next year. And what changes for them? It's a lot. One, here's number one, 30%. From 1st of July 2028, the trustee of an discretionary trust pays a minimum of 30% tax on the taxable income of the trust. Doesn't matter who you like distribute the money, does not matter what is a personal marginal rate. Trust pays the flow. So how this works in practice? The beneficiaries still declare the trust income to their own tax returns, right? Get a non-refundable credit for the trustee tax paid. So if your beneficiary is on a 47% marginal rate, the credit helps. But if your beneficiary is your 18 years old uni student on 20,000 part-time income, the credit is wasted. And we will show you one example where you can see the real example where it will make lots of difference. And critically, corporate beneficiary, the classic bucket company workaround, are denied the credit entirely. So that strategy is essentially neutralized. I know many people they are using it. So they can't do anything on that after July 2028. Treasury estimates about 350 small businesses use this trust. They say roughly 40% won't need to change anything because they don't take out money from there, typically because the income stays within the trust. Okay, but for other 60%, there's a meaningful change. There are exclusions which I mentioned earlier also. I'll just repeat it like fixed trust, unaffected, super fund, unaffected, compliant super fund, unaffected, disease estates, charitable, special disability trust. They are all and the primary production income trust excluded. So farmers, broadly speaking, are protected on this. Here is a strategic opportunity, the rollover relief. Now this is very important. So if you have property under the trust and you're using this, talk to your accountant in near future. Don't wait. There is a rollover relief. From 1st of July 2027 to the 30th of June 2030, there is a 3-year window where you can restructure out your discretionary interest typically into the company structure without taking the capital gain tax on the asset. That window is rare and it is valuable. So if you are in trust and new rules will cost you money, then this is the path for you. I can give a specific example so people can picture how it looks like. So let's take example of Steven. Say if he's earning 200K in the investment through the discretionary interest, he has been splitting that income across himself, his wife, and 2 adult children. 50,000 each, and normally this is how I know most of the people do. Under the current rule, that tax efficient, it is very tax efficient because each family member is on the really low rate. The total tax paid across the family is about 24,000 approximately. Average effective rate is around 12%. Now, under the new rule from 1st of July 2028, Stevens Trust pays 30% on the full 200K taxable income, regardless of how it is distributed, and total tax is 59,352. So Stephen loses about $35,000 in a year, compounded over a decade, that is 350K. Pre-tax wealth eroded. It's a big change for them. So if you are using your discretionary trust primarily for income splitting, the strategy conversation needs to happen now. Restructure to a company structure using the rollover relief window or accept the new tax flow and plan around it. Either way, do not wait for 2028 to look at this. We don't want to be having that conversation when you're already inside the change. So let's see who are the winners with this, who are the losers with this tax change. And Shiksha will walk you through that.
Yeah, thanks, Anita. So let's step back and zoom out because it's already 7:43. As we said there's a lot of information. So let's look at it and summarize what we actually covered, and let's see who are winners. So existing property owners, pre-May 12 May 2026, negative gearing, they are the owner, but the CGT they're still impacted until 12th May, and right. Until 12th May, they get the discount. After that, the rule CPI indexation rules apply. So there's no effect on property, which is good. First home buyers. So the Treasury is expecting that with this rule, 75,000 new home buyers or first home buyers will enter into the market. Property investors, there's impact. Affordable housing investors, there's no impact. The low growth, steady yield investors, there's not much impact. If you're buying grow much, then doesn't impact. New build investors, very good. Like you get to retain the gearing and the CGT method. You can choose between 50% and indexation, depending on whatever is low. So moving on to the next slide, needs to adapt. So buyers, right, with the established stock, they have to get negative deferred negative gearing, which we think is not big of a deal because if you own the SMSF, you already know that you get the benefits at the end. So SMSF property investors completely exempt, and we'll pass on to Benita to explain the lending for SMSF. affordable housing investors. So there's nothing they don't have to change anything. The only, I think, high growth hotspot investors, I think it's like a punishment for getting good growth in short period of time. So they will be the highest CGT payers. Yeah, and we don't know what is going to happen to renters after this change. And I think that's all. So this is I think quite a good slide. You can screenshot. It tells you when is what happening, like when is it announced, when the reform begins, when the trust. So all of that is in just one sheet. Just quickly cover this one. Yeah. So this is a quick wraparound of like what you should do, like beside what we are suggesting the buyers to do at the moment when so much chaos and uncertainty in the market. So new build, yes, it's a good one, but um, then it gives you the it gives you both the methods again also so that's a good way, but as house as well, what we are suggesting people is look, though there is CGT affecting at the end, but you get to access the equity, right? And that equity is the cash to build multiple portfolios. So it's, yes, there is CGT changes, but still at the end, with your investment, you still are in a better position rather than not. The other strategy could be moving SMSF buys or commercial. So those are not affected. Other thing can be maybe build granny flats to increase the income of the property, because if you're not getting negative, could be another good strategy to implement. Yep. Looking at the time, I'm just moving on quickly, so I'll not cover these suburbs in detail. These two slides, we'll just send these decks, and this where you get um, new opportunities versus a yield focused market. So what I'll do is I'll pass on to Benita.
Thank you. Thank you. So I'm just from Australian lending agencies, brokerage. We specialize a lot with self-managed super purchases. So before we get into topic, I just want to say that the information being is not financial, tax, or legal advice. So please ensure that you consult the right professionals before you implement this. So let's just dive right in. 2026 budget changed a lot for investors, as in this presentation. But like mentioned, super still remains untouched. So it's a great tool to build your wealth, and the gap between investing inside and outside your super just got wider, because it's a great tool to build generational wealth and also facilitate your comfortable retirement. So let's go into the points. Firstly, there's a 15% tax on your earned accumulation stage, which means that prior to retirement, any rental income being earned in your super is only taxed at 15%. Okay. Secondly, there is zero tax both on your earnings as well as capital gains. So post-retirement, you're not paying any tax. So it makes sense to kind of hold on to this asset long term. And the trust changes don't really affect here. So none of budget are affecting you in terms of, negative gearing or capital gains, because in a super you don't get. So let's talk about the kinds of property we can buy in super. So you can buy commercial property. With commercial property, there is an advantage because usually the yield in commercial property is, and using a buyer's agent is important for this because you want to choose the right asset. While commercial properties have a higher yield, they might also have higher vacancy. So when there's vacancy, you're not getting rental income to make the repayment on the loan. So make sure you choose the right asset and make sure you get help to choose an asset where you've got consistent cash flow. The property is tracking well in terms of capital growth. So that's quite important. Another added benefit of buying commercial property, if you are a business owner, is basically buy the commercial property, you can rent the property out to the business and you can claim it as a business expense for your business, and the income in your super, again, is taxed at 15%. So it's a great tool for business owners, but make sure you speak to your accountant to see if the structure is right for you. In terms of residential lending, again, it's very good for a long-term hold asset, because if we just industry, so let's just say you've got 200,000 in your industry super fund, and that might grow at 7 or 8% on average. But if you purchase a property in your, let's say valued at 800, that asset is compounding, depending on where you buy it, anywhere from 4 to 10%. Right? So you have the benefit of leveraging your finance and compounding the interest on the whole asset value as opposed to 800. So that's a great benefit. Another good benefit of SMSF lending is it doesn't affect your personal borrowing capacity, because anything that you buy in your super is not considered when you want to apply for a loan that you want to buy in your individual name or under a company. It's excluded. So that protects your borrowing capacity, especially in the current market where the interest rates are rising, where negative gearing is being scrapped. So that definitely protects your borrowing power, and it helps you get into the market and build your wealth. Then the structure for setting up a SMSF is a little bit more complicated than buying under a company or a trust. You definitely have to get your accountant involved. They will help you set up a company and a trust to manage your super. And when you locate the right property with the help of your buyer's agent, they will set up another bare trust and a trustee company. And that bare trust or trustee company essentially owns the property you're buying. So every time you buy one property under your super, you'll have to set up a different bare trust and trustee, and that's in compliance with the SIS Act. Other factors consider are exit strategy. So if you're a bit older, late and you're still thinking about buying your super, it's still a good for you, but you have to think about what you're going to do post-retirement. Are you going to keep the asset, or are you going to sell the asset? If you want to keep the asset post-retirement, how are you going to make the repayments, right? That's something to consider as well, and talk to your accountant. And the last point is long-term wealth shield, because the biggest advantage I see of buying in super is that you're not paying gains, and you're not paying tax on rental income if you hold the asset till you retire. So it's a great tool, like I mentioned, to build your and keep growing your pension, right? So that's a great. If I can just do the next slide. So the budget also came up with two other changes. The first one is a 250 working Australian tax offset. That's basically for all workers and business owners. You get a 250 offset. The other one is $1,000 deduction, basically for your expenses. So previously you had to show like itemized expenses as well as keep for all your expenses, but now if that's $1,000, you don't have to do it. It's an instant write-off. So the combination of these two benefits basically helped us with a borrowing capacity a little bit. Is the income that you get back by offsetting these two deductions will basically increase your borrowing power anywhere from 10 to 15,000, depending on your income. Of course, that could change up or down depending on how much money you make. And there's a few in there of what the benefits could be. And then on top of that, we might expect a few rate cuts in the next year. So all of that, what it's going to do is going to help you increase your borrowing capacity so that you can purchase more property outside your super as well. Thank you, Ankit, for me.
Yep. So basically, in the couple more slides, it's just that talk to your accountant before the 30th June, and understand the ownership structure, not from the past perspective, from future perspective. Yeah, if you like book and strategy session with us, we are happy to guide you through the investment journey. At the time, we'll move to the question and answers, and we have these commonly asked questions you can refer. Yeah, so this gives you instant answers to some of the questions. We want to quickly go to the questions.
We have few questions.
So the first question is like, I own an investment property I bought in 2018. Should I sell it before the rules kick in? Not really, because as we explained, the CGT 50% CGT you'll still get it 12th of May, and the new switch CGT will only apply after that. So it will be the capital gain tax needs to be accurately calculated based on this uh, these formulas. Um, so yeah, it will. And please talk to that. They'll do the exact figure based on the property valuation when you're selling it.
Yes,
So the
so-
next, yeah.
What is the next question, Shiksha? Because for some reason, I'm not able to see the questions on my screen.
Yeah, so won't all of this just push the rents up? Investors leaving the market, less rental supply. So there's a lot of uncertainty in the market at the moment, and looks like it push the rents up because the negative gearing will be passed on to the investors. Um, so it might push the rent up. Investors might start selling. Um, so there's less properties. That's another reason why the rents can go up. Or the other reason can be the owner occupiers will hold the properties for term. They don't want to sell it because of the new CGT rules, and then there won't be any properties. So there's a lot of ambiguity at the moment.
Yeah, and Treasury's own model, they are estimating that the rent would be to a week, case if increases. But many economists, they are believing in different ways. So the honest answer, we won't know until next 2 to 3 years that which way it plays out. It could be that rent goes really high or it doesn't act. So we will have to see, because if people are investing more on new builds, then the rental supply will be, then the rent will be contained. So it will be a game of wait and.
So the next question is, I've been thinking about buying my first investment. Should I rush to buy before 1st July, or lock in to the old rules? So I think buy only if it suits your strategy, because the changes, it come, but it's something which we don't hold on new ways to do it, maybe in some other assets. So are the house prices going to crash because of these changes? We get all these questions every time, and house prices will only crash once we have oversupply in the market, and that's never going to happen.
For this budget, they have done a modeling. They are expecting the prices to slow down, but they are expecting the growth price will be 2% slower over the next couple of years. So if they are expecting say 6% possibly, it will be 4%. So it's not falling. The growth is slowed down. That is the expectation.
Yeah. I own my investment properties through a family discretionary trust. This question we will actually leave it to your accountant to answer. But yes, if accountant says it's not it's not good to hold investment properties, you can try to PTY company as well. But that question will be for accountant. How does the definition of new build work? Do all plan apartments count? What about the granny flats, knockdown rebuilds?
This is an interesting question, and many people are talking about it. So, like, there are few things like the new house, if a knock down the house, and basically the definition of new build could be that nobody has stayed in the house, but like if suppose somebody has done a renovation, that won't be new build. And if regarding anybody building new granny flat, again I think next 12 months will, the detailed level, the legislation which will come out, because they still have to figure it out. But based upon our knowledge, the granny flat stays under the title of the existing house which is old. So it might not be accepted as a new build,
New build.
and negative gearing and other things can't be used. But again, wait for next 12 months. So as of now, direction is clear, but the details are yet to be out. So it will take some time for all these things to be out.
I think that's all. Finally finished.
Also, there is one last question from Sandeep that from now, shall I just buy the new bills? Again, so as we mentioned earlier, that so there is no default here. Every different and their property and there is different. And we have shown in one of the example of Yunsu, I think the name was there, where we showed that the property purchase was 519 and over the period of 10 years, the difference was $182, I guess. So then that is not a huge amount. So this is case to case basis. If you have any questions or want to know more about that, we can definitely help and go through your case and your existing portfolio, and we can work from there. If you have any more questions, we done for the day. It was a long evening today, isn't it? But it's a big topic, important one.
And a new topic.
Yeah, every single investor is going to be affected in some way, either winner, either plan, as simple as that.
All right. Then no more questions.
Yeah. Thank you.
Thank you, everyone.
Yeah. Thanks. Bye. Have a nice evening.
Thank you.